I think the broad estimate of the effect of QE has been about a 90 basis point reduction on long-term rates. So we do know that the Fed is not intending to reduce the balance sheet back to pre-recessionary levels, which would be less than $1 trillion. Assets have to equal liabilities plus equities, and the vast majority of assets on the Fed's balance sheet are backed by liabilities that the Fed can't reduce, currency in circulation, foreign reserve deposits, etc. So at most, in an ideal scenario, we would expect that balance sheet to be cut in half. So now you're looking at just about a 45 basis point effect on longer term rates. And of course, the Fed has also said they want to extend this process over a number of years, 4 or 5 years. So really, you're talking about a very muted 9-10 basis point impact on the market. Right now, the pressure on longer term rates is not about the balance sheet. It's about the Fed hiking rates at a more aggressive or a perceived more aggressive pathway than the economy can withstand.
Lindsey, when I was reporting this story that I just delivered, a couple of folks talked about the psychological aspects of this, that there are the mechanics, and you and I could, I'm sure, bore people about the mechanics of the financial plumbing for quite a long time, and we'd find it interesting. But here's the thing. The idea that the Fed stepped forward in a big way, put trillions into the system. Nobody really knew how it works, and honestly, nobody really understands how it works on the way out, but they know they were in before, they're out now, or getting out now, and I think that may have a bigger impact than the Fed is estimating.
Well, I think there is a psychological impact, and I think Powell can counteract that by simply reassuring the market that they're willing to adjust the pace of balance sheet movements depending on the evolution of the data. So reminding the marketplace that increasing the federal funds rate is not their only tool to combat weakness, saying we're also willing to back off from tapering reinvestment, and we're willing to increase outright asset purchases should the economy show significant signs of weakness. So I think we can combat that cycle.
Yeah, Lindsey, keeping you all in this discussion, so this is what's so interesting, Steve, because the way that Powell talked about it, he made it sound like the balance sheet was not a tool of monetary policy.
No, that's a big part of, they got there as, I believe, my personal opinion, is part of a compromise between the hawks and the doves. It allowed them on the dovish side to raise rates more slowly, while they told the hawks who wanted that balance sheet eliminated, essentially, to hang on, we'll do this in an automatic way, and we won't adjust. What Lindsey is saying makes sense, except for the fact it would be a massive reversal for the Federal Reserve here to do that.